Hello, this is Jordan. This video is being recorded on the late evening of Friday, January 25th, 2024. Thank you so much for tuning in. And in this video, I'm briefly going to talk about the interest on the debt. It has hit $1 trillion. When is this really going to matter for the economy and markets, and most importantly, gold? And this is going to be a brief video. I'll get into that. And because I think when will it matter for gold, that question, I think there's two potential answers, and I'll get into that a little bit with some charts. So first things first, credit my friend Brian London. I noticed on Twitter, he tweeted about this. Great chart there from the Econ Fred website. You get a lot of great statistics, a lot of great charts. We could see this thing, again, this is just nominal terms. It's gone parabolic in the last couple of years. Up to $1 trillion. So that's ridiculous. So that's what we know. Now, to put it in context, here are a couple of charts. And I was looking on Twitter. You know, I kept track of a lot of this data myself until, I don't know, 5 or 6 or 7 years ago, something like that. And I wrote my first book in 2015 about it. And, you know, I didn't really continue to track the data. But I might start doing that again. But anyway, so this chart, I like this because it goes back to 1940, and that's what we really need to see. We need to see the context of our entire history back to World War II, because we know that here, I think this was 1947 or 48. This is one peak after the war, and then this is another peak in the early 90s. Around 1990, mid-90s, you could say. I remember Ross Perot railing about this in the presidential debates. And we could see that this was a real problem. Of course, interest rates came down significantly after that. And, we had the China boom, the tech boom that really helped the economy. Interest rates plummeted after that. Of course, the Fed, that was their policy from Greenspan on to the present day. But anyway, now there's different ways of looking at this data. A lot of charts out there, they show it as a percentage of GDP, but I really don't care that much about it. I think what really matters is how much your interest payments versus how much you're taking in, because that's what really matters. And this is what this chart shows. You have interest payments as a percentage of federal government receipts. So interest payments divided by how much money the government is actually taking in. This is interest payments divided by federal outlays, but I believe that includes deficit spending. So this is basically interest payments divided by income plus deficit spending. This is just interest payments divided by income. So this, I think, this is a better chart, but I like this one because it goes back 80 years, and we can see that, when these statistics start taking out these peaks, I think that is going to be really significant for gold. I think that could be one catalyst. Like when we see interest on the debt, when it goes above 16% here, it's a no-brainer. That's obviously, they're going to have to do yield curve control at that point, or they will have already started it, which will be super bullish for gold. But this, I almost forgot about this. So these are the statistics for fiscal year 2023. And so we're past that now. We're into fiscal year 2024. But just to give you an idea, so 4.4 trillion in income plus a deficit of 1.7. So you had over 6 trillion in spending. Now, if you're just thinking about the interest on the debt, I don't know. So this is, I think this is 14 or 15% or so. I don't know. Maybe this chart was done a couple of quarters ago, because if you're looking right now and you have 1 trillion, 1 trillion interest divided by 5, that's 20%. So divided by 4.7, the economy's been doing better from fiscal year 22 to fiscal year 23. Income actually went down. So the economy's been growing the last couple quarters, so the income will probably go up. But anyway, if you take 1 trillion divided by 5, that's 20%. So I don't know when this was done exactly. Now, also 1 trillion divided by 6.1, that's 16%. So if this were up to, this might be up here already. So There's a real, what I suspect you could see is, we kind of get a result. The economy's growing this quarter, next quarter, you get a resumption in inflation concerns. These lines continue to go parabolic. It's a real problem. And then, when you get a recession, it'll come back down. And then it'll be, in the next expansion, they'll have to do yield curve control. So that's just one editorial comment I have. But I know I'm droning on about this. But basically, we'll have to see where these things are. But, maybe next quarter, these are going to be above, mid 90s levels at an all-time high. So that's definitely something to keep an eye on. And I think when it gets to that point, that's really bullish for gold, obviously, unless something else already happened before it gets to that point. The other answer, I think, and I think this is the answer to also when is the stock market, when is the secular bull going to end? Now you look back, if you look at the secular bears, you have 68 to 82, 66 to 82 if you're looking at the Dow. 29 to 42, that was deflationary, but 1906 to 1921, that was inflationary. So interest rates, the 10-year yield was going up consistently after 1900, so that impacted it. 29 to 42, it did not impact it at that point because it was deflationary. So this is setting up, I think, like those inflationary times, like 68 to 82. And so I want to go back and look at this. So this is a 10-year yield. This line is 5%. This line is 6%. And so we can see this is when, inflation started taking off in the mid 60s. This is a 10-year yield around 4%, basically. So when it moves from 4 to 5%, that's the peak in 1960s. That's when the Dow peaked. This peak is only 15% above this peak. So you basically had two peaks if you think about it. So only a 15% difference. And so this was just 4 to 5%. Now it went above 5%. It came back down after 66. So the market was able to rally a little bit more. Then 67 was when, this peak here was around 5.5 right here. And once it broke above 5.5, that was also around the peak in 1920. So once it went above here in 5.5, this was like new, close to 50-year highs. So that's a really, really significant breakout. And we can see when this happened, the market had one last push. And then basically when the 10-year reached 6% and kept moving, then the secular bull from the 50s was officially over at that point. But the main point, when this moved from 4 to 5%, it really started to slow down. So 5%, in real terms, the market was already fucked. It was already dead. So this move from 4 to 6%, that's really what ended it. Now 5%, this is significant historically. Again, 5.5, the 1920 peak is 5.3, 5.4, something like that. But let's fast forward to one more thing actually. So the yield continues to go up here, cyclical bear. Yield goes up here, cyclical bear. Now, again, yield goes up here. But once you got, the end of the 70s, the early 80s, the end of the 70s, gold went parabolic. It was like a run. It was at that point, it was like a run to assets. So the S&P did not crash or collapse, because it was inflation. People, they're buying metals, commodities, the stocks just, it was at that point. It was nearing the end of it. But you get the point. Higher yields, higher long-term yields, bad for stocks. We're starting to see that again, because look at 2022. Look at how much the 10-year yield went up from 1.3 or whatever up to all the way to 4%. You had this decline when the Fed was tightening. Now, again, you saw a little bit of that at times last year, I think until October. But when the 10-year yield and the market rebounded when the 10-year yield came back down. But then when it made a new high and it rallied up to almost 5%, 4.98%, the market came down like this. Yield comes back down below 4%. Now it's bumped up again above 4%. Market rallies. So if we see the 10-year yield, get back to 5%, that to me is when the secular bull in the S&P ends. So, the stock market, new high, probably has more room to run. Obviously not great for gold and precious metals, but continue to watch the 10-year yield. So getting back to the interest on the debt, interest on the debt, it's all related. If you see the 10-year yield, if we see that go above 5%, I think that's really the trigger, because historically, it was also the trigger here. We have way more debt this time around. Maybe it'll happen before it gets to 5%. But this, to me, if we're not going to have the disinflationary or deflationary recession and we're going to see the economy grow this year, this is the metric to watch. When this hits 5%, in my view, that could be when, when the secular bull ends. And yes, there'd be a recession. It comes back down. Then when it goes up again, they'll have to do yield curve control, because the interest on the debt after the reset will be out of control. So I know it's a long video. Ended up longer than I wanted to, but that's just something to think about with respect to interest on the debt. Let me know what you think in the comments. Talk to you guys again in the next video.